Watching out for more details to follow, but thanks very much for telling us what we know so far, Srishti. Meanwhile, the big news is about the stock of Silicon Valley Bank, SVB, which has plummeted a whopping 60%. This has happened after the bank announced a $1.75 billion stock sale, which has pushed the bank's market capitalization to just above that $6 billion mark. The company sold close to $21 billion worth securities from the portfolio it had. It has driven the after-tax loss for SVB to $1.8 billion for the first quarter of this year. And this sell-off has come as the bank required to raise funds just to sustain its business. The move has dragged other major banking names like JPMorgan and Citigroup and Bank of America as well. In fact, the S&P 500 bank has tumbled as much as 6%. It's the biggest single-day decline in over 2 years. But now also an important question to ask is, will this have a spillover into the Indian banking sector? And to discuss this, market expert Ajay Srivastava is joining us, along with Manish Singh, the Chief Investment Officer at Crossbridge Capital. Great to have you both, gentlemen. Ajay, to you first. As one would expect, these bank stocks everywhere in the world, in Asia, in Europe, they've taken a knock after those troubles have been reported at Silicon Valley Bank. It has triggered fears of a wider problem for the financial universe. Do you foresee wider problems?
Problem is there for all to see, because with the yields going where they are, almost reaching 5%, I think you have a serious problem in terms of the bond holding of the global corporations. And the number two is the fallout impact is going to happen on the capital market, debt market around the world, which means that the company's ability to borrow money in the global markets, that's going to be at stake, not only because of the interest rate and what's happening to the bond, but also because there is a problem in terms of getting deposits to match the credit, which you've seen in India as well. The banks are not able to generate the same level of deposits to match the credit outflows. So, from a global perspective, it's going to become very difficult for companies, or more and more difficult for companies to borrow money, certainly on the lower of the credit tier. And you saw some of the fallout which happened to the Adani stocks, etc. So therefore, the fallout may not directly come in terms of the bank, but it will certainly come in terms of bank portfolios having companies which may or may not be able to refinance their foreign currency borrowings. And certainly not at the rate that they borrowed the first time. The first time they borrowed 5 years back was a 0%, 1%, 2% interest rate. Now it's going to be 7.5%, 8% dollar borrowing, say for a developing country like India. And that has serious repercussions in terms of the entire banking sector, because the fact that their companies, their constituents, their lenders may find it very difficult to now raise money, and therefore resort back to the domestic credit, which itself is getting into problem because you have in terms of deposits. Having said that, I think the central banks are cognizant of it. You saw stability coming back even today in the market, that they will not let this contagion spread. So I think all eyes are on central banks to say, will they come, step in, and be the lender of the last resort, just the way RBI does in India. The Federal Reserve will do that in America, and the other central banks. So I think the market can take some comfort that there will be central bank intervention. But the problem is there is not going to go away, is the depositors want higher rate of money, and there is definitely a shortage of dollar debt in the world markets.
So is it a given then, Manish, from what we are hearing, that contagion is something that we can expect, and central banks around the world, the onus is going to be with them to control the contagion? With the stake sale in SVB, we know of the 4 largest US banks losing more than $50 billion in market value. So how deep do you think the banking sector is going to bleed? How real to you are the fears of a contagion?
So let me say at the outset that I do not see a contagion. And I think that people have to really isolate and see what's happening at SVB. So let's look at the facts on the ground. SVB is a small bank on the scale of things. I point out to you, small banks always try to pay high deposit rate to get more deposit. Bank of America in Q4 last year paid 0.94% on deposit. SVB was paying 2.33%. That just tells you where things are. Second, SVB was mismanaging the deposit that they had. They had a total deposit of around 180 or 190 billion. They put 85 billion or 80 billion of that in 2021 into mortgage-backed securities at 1.65% yield, 10-year mortgage-backed securities. Now that's reckless. Any management, anyone that does such thing, they should be wiped out, because if they take that risk, then they are going to lose their shirt over it. So I have no sympathy for stock falling by 60-70%. I think that a large part of that is speculative attack, and you might see stock rise as well. I'm not recommending a buy on this. I'm just trying to point out that it has nothing to do with contagion. It has to do with the way the assets were managed by this institution. So it's an isolated case. At bigger banks, they have other means of investing the deposits. They do not just put in mortgage-backed securities and other things. They lend in a different way. So I would not see this as a. Now, the second thing, which I think your colleague Ajay pointed out, you have to always look at the reaction function. In my opinion, as I have been saying this to you, Vikram, is that we are at peak rate. Any rates higher than that is going to damage the economy. Fed knows that. Therefore, Fed is very cautious about what it does. You have to worry about the reaction function. The reaction function will be the rates are going to come down. So even in the case of SVB, it is being made out this is Lehman 2.0. It is not Lehman 2.0. They have tried to raise $2.5 billion of equity, which they have failed, by the way, half an hour ago. So which means somebody who is going to buy this bank out, most likely the likes of JPMorgan, whoever. And once it is bought out, depositors are fine. So the rumor mongering that started with, they're having a loss on their book, which was true because they had disclosed this in the annual statement. It was going on. So as the rates rose more and more, something you bought at 1.65% yield, and now the yields are at 5 or 6%, is going to cause you paper loss. And then when the deposits started leaving, it is a classic case of bank run. That's what has happened. So this is not the case with other banks. They are far well capitalized. They were not in 2008 where banks were undercapitalized. Regulations have been very strict and very strong on that. And we have seen these numbers regularly. So I don't see this as a contagion, but I do see this is a case of how mismanaged some institutions can be.
Yes.
Can be, and that's what has happened.
Ajay, do you believe this is possibly a mismanagement of deposits, like Manish says? Would you concede ground at least to that point? He believes, of course, it's a one-off case, that there is no contagion to be expected. But SVB has offloaded its government bonds to raise these funds. And naturally, it raises concerns about the value of bonds held by banks in a rising interest rate scenario. How severely have rising interest rates affected bonds? Have they truly become less valuable? How true would this be for the Indian banking sector as well, and the bonds that are held within the Indian banking sector?
Of course, it's a natural corollary that when the interest rate goes up, the value of your bond falls. So if you bought a bond, just like what he said, Manish said, you bought a bond which gives us 6% interest, and now the interest rate is 8%. Your 25% of value of the bond has gone down. And that is why very often you'll find that the RBI comes up with increases and says the bank in India can hold the bonds to maturity, which means they don't have to mark to market. So the central banks have been very alert to this one, and that is why they protect the bank by saying, okay, you're holding it to maturity, don't need to mark it to market, and therefore it's the losses. But you can't run away from the fact that the market portfolio the banks are carrying is going to record a loss in the books at this point of time because the way the interest rates have gone up. So the reality is the banks are sitting across the world, including India, are sitting on losses. The key aspect is, are the losses manageable in the capital structure that the banks have? Possibly Indian banks, the larger banks definitely are better capitalized, so they can handle this loss better. But certainly what it does to the average investor is that the earnings are going to be splattered with red for the provision for bond losses across the books of Indian banks, global banks, everywhere. Number two, interest rate rise not only has killed the bond portfolios because of interest rate, but also ability of the lenders to now service the interest. You can look at AAA corporations, yes, they can. But when you go down BB, BBB, and you look at the Indian profile, all the growth in Indian banking has come from personal loans. Now, there will be a threshold point where your income doesn't go up, but your EMIs start to go up in a manner that you're not planned for, whether it's your mortgage, whether it's your personal loans. And India banks are very vulnerable today because their entire growth is now coming from personal loans to individual, which are all unsecured loans. So you have a bond portfolio which is at risk. You have the loan portfolio which is at risk. So from investor standpoint, as we are talking, it's a double whammy coming to the back, and triple whammy actually. Your bond portfolio is going to record a loss. Your lending profile, which is personal loans, the ability to pay back the loan is now falling, and therefore growth or repayment is going to suffer. On the third side, to get capital depositors, they need to pay higher. So if you're an investor in a bank, I think you looking at a situation that banks which are supposed to be eminently profitable, interest rates going to go up, they'll do well, are not going to do well. And unfortunately, the worst problem is everyone in this country and globally is over invested in the banking sector. So it's all people are sitting with more stock they want to own, they all want to get out at the same time. And that's why when you say contagion, it's also because a lot of people are rushing to the exit at the same time, saying banks are going to have a problem in terms of getting me returns. If I'm an equity holder, might as well sell, buy the sovereign yield. And if you saw yesterday, the bond yields, sovereign bond yield across the world came down because there was a flight to safety. So as you've invested in banking stock, whether contagion happens, doesn't happen, I think the P&L of banks is going to look a little more uglier than you thought of, and the returns are certainly not going to come through as you had planned. And you are over-invested, you want to get out, there are no exits.
Manish, so Ajay is clearly saying that it's a triple whammy on the loans front, on the kind of deposits that they have. And indeed, as far as the panic button is hit, then people want to bring out the money that they have put in. So at this point in time, when you're seeing the rising interest rates, do you also believe that, like SVB, there could be several other financial institutions that could be sitting on large unrealized losses on their fixed income holdings as well with these rising interest rates? Should that spark fears?
Bank, and it comes down to how you operate. But if you're a smaller bank where you are not able to attract deposits unless you have to pay a lot more, that is a problem for that bank, because their asset side has gone down in value unless the rate cuts start, and their deposit, they're not able to attract enough deposit, or they have to pay a huge amount compared to other banks. Then you have a problem. So that's absolutely a fact, which is why you got to stick to size. Like if you look at Bank of America on their holding portfolio, which is hold to maturity, they have 109 billion paper loss, but that doesn't panic anyone because they have huge amount of capital to look past that. So you have to be careful about what bank stocks you're holding. When I said I'm not afraid of contagion, I meant is that not a contagion in overall market, because the bigger banks are well capitalized, they will see this through. But again, when the interest rates are very high, just like any business, if you are a small business which has to borrow on revolving credit and the interest rates are high, you are in trouble if you're not able to generate enough revenue. So yes, some people or some institutions will have problem, which is why you had Silicon Valley Bank, you have the SI, the other one, in the crypto thing, you had a problem. So that's classic case of asset liability mismanagement and understanding that what lies on your book. So those people are going to get caught out. By the same token, if you compare the banks in Europe, or in Eurozone at least, they're going to make huge amount of money over next 12 months, because they're still paying very small deposit amount. On deposit, they're paying very small amount. They're getting much larger amount from ECB, and they're making money on the loan book. So you have to differentiate. So when you're investing in banks, you have to be very careful which region and what is lying on their liability book, and you have to be careful about that.
Fair enough. So you have made it clear that you don't expect contagion in the overall markets, though one has to understand that with these financial institutions like SVB, for one, has been a big lender to technology startups. Some startups that have money deposited with SVB, they have been advised to withdraw those funds, and that's coming through in reports. So how the tech startup universe is likely to get hit with this news, and that's just one sector. We'll have to keep watching that space. Already the crypto universe is falling apart with Silvergate debacle, and now we are seeing much more happen within that entire universe. We'll keep tracking developments. Unfortunately, out of time. We would have loved to have a longer discussion, but Manish and Ajay, thank you so much for joining us with your perspective as far as the fall in SVB is concerned. Meanwhile, we're watching what's happening on Wall